Two investors each put $10,000 into dividend ETFs back in 2015. One reinvested every single dividend payment. The other took the cash. 10 years later, the investor who reinvested might earn an annualized return over 10% higher. But here's what nobody tells you. That gap doesn't show up in year 1 or year 3. It barely registers in year 5. The real difference explodes in years 7 through 10, when the snowball picks up so much speed that it becomes nearly impossible to catch. Most people think dividend investing is about collecting checks. That's the surface-level understanding. What they're missing is a wealth-building mechanism so powerful that Warren Buffett once attributed most of Berkshire Hathaway's success to it. And the wildest part? 2 ETFs trading right now are specifically designed to exploit this effect, but they do it in completely different ways. Quick disclaimer: I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Today I'm breaking down exactly how the dividend snowball works, why most investors abandon ship right before the magic happens, and how 2 ETFs, one you've probably heard of and one that might be flying under your radar, are structured to accelerate this effect. The math at the 70% mark might genuinely change how you think about long-term investing. Here's what nobody explains about compounding dividends. When you reinvest a dividend payment, you're not just adding to your share count. You're creating future dividend payments that will themselves be reinvested to create even more shares. Those new shares generate dividends. Those dividends buy more shares. The cycle feeds itself. But there's a catch. In the early years, this effect is so small it's almost invisible. If Harry invests $10,000 in an ETF yielding around 2%, his first year generates maybe $200 in dividends. Reinvested at the same price, that buys him roughly $10 additional worth of future annual dividends. $10. That's nothing. That's a coffee. Most people look at this and think, what's the point? The point becomes obvious in year 15. By then, Harry's dividends aren't generating $10 in additional future income. They're generating hundreds. And by year 25, the annual dividend income alone could exceed his entire original investment. Not total return, just the income. This is the snowball effect, and understanding why it accelerates is the key to everything that comes next. The reason most investors miss this comes down to psychology. We expect linear progress. We invest money. We want to see immediate results. But compounding doesn't work linearly. It works exponentially. The first 10 years feel like pushing a boulder uphill. Years 10 through 20 feel like the boulder is starting to roll on its own. Years 20 through 30 feel like you're just trying to stay out of its way. Data from the S&P 500 going back decades shows that investors who reinvested dividends might earn roughly twice as much as those who didn't over 30-year periods. Not 20% more, not 50% more, double. And that gap continues widening the longer you hold. So why don't more people stick with it? Because year 3 looks almost identical to year 1 on a dollar basis. The psychological reward isn't there. Meanwhile, some hot growth stock is up 40% in 6 months, and suddenly patient compounding feels like a fool's game. This is where the right investment strategy matters enormously. Now, you might assume any dividend ETF would capture this snowball effect equally. That assumption would be wrong. The specific mechanics of how an ETF selects and weights its holdings dramatically impact how quickly that snowball grows. Let me introduce the first ETF, and this one has quietly become the largest dividend ETF in the entire market. I'm talking about the Vanguard Dividend Appreciation ETF, ticker VIGs, with over $120 billion in assets under management. As of late 2025, this fund has attracted more capital than any other dividend-focused strategy. But here's what makes VIG different from most dividend funds. It's not actually chasing yield at all. VIG tracks the S&P US Dividend Growers Index, which requires companies to have increased their dividends for at least 10 consecutive years. Read that again. 10 years of uninterrupted dividend growth is the minimum requirement to even get considered. The expense ratio sits at just 0.05%, essentially nothing. You're paying $5 a year per $10,000 invested. Current yield hovers around 1.6%, which looks low compared to high-yield alternatives. But that low yield is completely intentional. See, VIG deliberately excludes the highest-yielding 25% of eligible stocks. Why would a dividend fund exclude high-yielders? Because extremely high yields often signal companies in distress. The stock price has crashed, inflating the yield percentage, and a dividend cut is likely coming. These are called yield traps, and they destroy portfolios. As of late November 2025, VIG's top holdings include Broadcom at around 7.6%, Microsoft at roughly 4.4%, Apple at 4.2%, and JP Chase at about 4%. Notice something. These aren't the dusty, slow-growth dividend aristocrats your grandfather bought. This is a blend of financial planning titans and technology leaders that happen to also raise their dividends consistently. The sector breakdown tells an interesting story. Technology makes up nearly 30% of the fund, unusual for a dividend strategy. Financial services accounts for over 21%, healthcare around 15%, and industrials at 10%. This is not your traditional income portfolio. VIG returned about 17% total return in 2024, and as of late December 2025, it's tracking around 15% year-to-date. Over the past decade, the fund has delivered roughly 11% annualized returns, with notably lower volatility than the broader market. During the 2022 market sell-off, VIG outperformed the S&P 500 by about 10 percentage points. Lower volatility might sound boring, but it's actually crucial for the snowball effect. When you're reinvesting dividends into a crashing market, volatility hurts because you're buying shares that keep falling. VIG's stability means your reinvested dividends maintain more of their purchasing power during downturns. But VIG isn't the only way to play the dividend snowball. There's another ETF that takes a slightly different approach, and for investors focused on passive income streams, the difference matters. The iShares Core Dividend Growth ETF, ticker DGRO, has accumulated around $36 billion in assets and carries an expense ratio of 0.08%. Slightly more expensive than VIG, but still essentially free compared to actively managed alternatives. DGRO tracks the Morningstar US Dividend Growth Index, which requires 5 consecutive years of dividend increases, half the streak VIG demands. It also screens for payout ratios under 75%, ensuring companies aren't overextending to maintain their dividends. And crucially, it excludes the top 10% of highest yielders to avoid those yield traps we discussed. Current yield sits around 2.1%, meaningfully higher than VIG's 1.6%. That extra half point of yield might seem small, but over 20 years of compounding, it materially accelerates the snowball. Top holdings as of late December 2025 include Johnson & Johnson at roughly 3%, Microsoft at around 2.9%, ExxonMobil at 2.9%, JP Chase at 3%, and Apple at close to 2.9%. Notice the more equal weighting? DGRO caps individual positions around 3%, creating broader diversification than VIG's more concentrated bets. The fund holds approximately 406 stocks, significantly more than VIG's roughly 340 names. This broader exposure reduces single-company risk but potentially dilutes the impact of top performers. DGRO's 2024 total return came in around 16.6%, with 2025 year-to-date performance tracking close to 16%. The 10-year annualized return sits near 13%, slightly better than VIG over that specific period, though both funds trade performance leadership back and forth depending on market conditions. Here's where things get interesting for the snowball strategy. DGRO actually increased its dividend payout by 18% in the fourth quarter of 2025 compared to the same quarter the year prior. That kind of dividend growth acceleration is exactly what compounds the snowball effect. The 2025 reconstitution added 44 new holdings averaging about 2.6% yield and 8.5% dividend growth rates. Meanwhile, it removed 43 names that were yielding over 4%, but only growing dividends at 5% annually. The message is clear. DGRO is prioritizing growth over current income. So which one actually builds wealth faster? This is where Harry comes back into the picture. If Harry invested $10,000 in VIG 10 years ago and reinvested all dividends, his position would be worth approximately $25,000 today based on the fund's roughly 85% 10-year total return with reinvestment. His annual dividend income would have grown from roughly $160 to somewhere around $400. The same $10,000 in DGRO over that period would show similar total value growth, but with higher current income generation. DGRO's slightly elevated yield means more dollars are reinvesting each quarter, even if the total return percentages end up comparable. But neither approach is obviously superior. VIG's tech-heavy positioning means it captures more upside when growth stocks lead. DGRO's broader value tilt and higher yield provide more cushion during tech sell-offs and generate more reinvestable income throughout. The real insight isn't which fund to choose. It's that either fund, held for decades with reinvested dividends, will likely generate wealth that dwarfs what most investors achieve by jumping between strategies. One study on the S&P 500 tracking the difference between dividend reinvestment and cash collection found that an investor who reinvested from January 2023 to April 2025 earned 10.1% annualized returns versus 8.1% for the non-reinvestor. That 2% gap doesn't sound life-changing until you project it forward. Over 30 years, it's the difference between $223,000 and $124,000 from the same initial $10,000 investment. Both VIG and DGRO are specifically engineered to capture this compounding advantage. VIG does it through stricter quality screens and growth stock inclusion. DGRO does it through broader diversification and higher current yield. Neither is wrong, both work. The mistake would be switching between them every 2 years based on recent performance, never letting either snowball build momentum. For retirement planning specifically, the choice might depend on your timeline. Younger investors with 20-plus years to compound might prefer VIG's growth tilt, accepting lower current income for potentially higher total returns. Those within 10 years of retirement might lean toward DGRO's higher yield and value orientation, prioritizing income generation over capital appreciation. But here's what neither fund can fix: investor behavior. The single biggest threat to the dividend snowball isn't market crashes or recession. It's the investor who abandons the strategy in year 4 because it doesn't feel like it's working yet. Remember what I said earlier? The snowball barely moves in the early years. It feels pointless. It feels slow. Meanwhile, some friend of yours bought NVIDIA at $80 and now they're up 300%. The temptation to abandon your boring dividend strategy and chase momentum is overwhelming. And that's exactly when most people bail. Right before years 7 through 10, when the compounding actually starts accelerating noticeably. Right before years 15 through 20, when the annual dividend income starts matching new contributions. Right before years 20 through 30, when the snowball is generating more wealth per year than most people earn from their jobs. VIG and DGRO both returned around 15 to 17% in 2024 and are tracking similar numbers through 2025. These are not sleepy, underperforming funds. They're world-class wealth-building machines disguised as boring dividend ETFs. The dividend snowball isn't a secret. The math is freely available. The ETFs trade every single day. Anyone can buy them. Yet almost nobody actually captures the full power of compounding because they lack the patience to let the snowball build. 10 years from now, most investors will look back and wonder why their portfolio diversification strategy didn't work. They'll blame the market. They'll blame their broker. They'll blame bad luck. The truth is simpler. They never let the snowball get big enough to matter. If you want to see exactly how different holding periods affect the dividend snowball and which combinations of yield and growth produce the fastest compounding, I break down a specific 30-year simulation in this video right here. It might change how you think about compound interest entirely.